Hi everyone, how are you? I hope all of you are doing really good with your preparations. So, in this session, what we are going to do is, in this session, we are going to discuss the RTP Financial Management RTP ICAI January 2025 attempt. Right? A good RTP for your practice, sir. Let's quickly discuss and let's see what is there in this RTP. There will be the case studies are there, some practical problems are there, the MCQs are there, because as you all know, the pattern is now case study, MCQs, everything we have to cover. So let's see question number 1. Case study you have to attempt very carefully. That is the most important thing, right? For case study, because that is one area that can little bit trouble you in the MCQ part. Rest of the MCQs will be more or less easy and simple conceptual part will be there. But this case study part you have to deal with it carefully, because it will combine multiple chapters into one case study. Right, it is not necessary that only one chapter will be asked in the case study. So it can be the multiple chapters combined into one case study. That is why now we cannot leave even a single chapter. We cannot leave even a single topic. That's how the institute is going to test you guys. Okay, so let's start with question number 1. Samvar Limited, a leading FMCG company having its current presence in more than 150 Tier 1 and Tier 2 cities in India. The stores are operating in the brand name of GoMart, competing with Reliance Fresh, Walmart, Big Bazaar and other chains. Owing to the increase in demand from the Tier 3 cities and the rural areas, it is planning for the massive expansion and is contemplating to open up additional 50 stores which will have a variety of FMCG products. Okay, sir. It's like D-Mart, Reliance Fresh, Walmart. It is this company is operating the FMCG stores. Currently, it is operating in only Tier 1, Tier 2 cities. But now with the expansion in the demand, they are planning for opening more stores, 50 stores in the Tier 3 and the rural areas. The CFO and the team estimate that the funds needed for the massive expansion would be rupees 200 lakhs per store. For every store, the investment required will be 200 lakhs. Great. Such funds would be utilized for buying out a space, setting up a store, buying the other required fixed asset, etc. Central government will provide a revenue subsidy of 15% on the gross profit if the overall cost of capital, right? Okay, this is written twice. Overall cost of capital does not exceed 10%. If the overall capital is less than 10%, then the government is ready to provide subsidies, that is 15% on the GP. Fine. Apart from above, the CFO and its team require an estimate on the additional capital needed based for the smooth running of the fixed assets and its daily operations. Which capital is this? Sir, kind of working capital. They want to know what will be the requirement of working capital, sir, for the smooth operation, for daily operations and for the smooth working of the fixed assets. Based on their market research, they have collected the other information for each store, which is as follows. Average sales would be rupees 120 lakhs per annum with a gross profit margin of 18%. Okay. The customers pay through different digital modes and the channels, including the point of sales POS system, debit and credit cards, which generally takes about 9 days for the funds to get credited in the bank account. 15% of the customers use the debit and credit cards to make the payment. Installing a POS system comes with a fee of 2% of the total sales through POS. POS is through debit and credit card. And see, when we talk about these chains, right, FMCG stores and all, most of the payment is through cash. Right, that is, the payment is received immediately. But where the payment is through debit and credit card, there is a period of 9 days when the payment is to be received in the bank account. This is what the question says, right? And 15% of the customers, out of the total customers, 15% customers pay through this debit and credit card, right? So out of 100 customers, 85 customers, they will pay through cash. And when we talk about cash, it is the immediate receipt, sir. There is no debtors, nothing. There is no receivables. But for 15% customers, they pay through debit or credit card. debit or credit card, in that case there will be the debtors for how many days? For 9 days. After 9 days, so you will get the payment, sir. Clear? Being a FMCG outlet, the inventories of the multiple products need to be kept. The different products have the different storage period. However, primarily the products are classified into 3 broad categories, that is durable, semi-durable and perishable. The perishable product comprises 60% of the sales, whereas semi-durable is 25% and the balance is for the durable, sir. 15% is for the durable, right? Fine. The inventory storage period for the perishable, semi-durable and the durable products are 10 days, 30 days and 60 days respectively. So out of the total sales, he says how much is there? 60% of the sales is of the perishable products. Right? Inventory basically is of the perishable products. 25% is for semi-durable products. It is for semi-durable products. And the remaining 15% is for durable products. And the holding period is given for this inventory. What is the holding period? 10 days, 30 days and 60 days. What is given to you? Another thing that is given to you is holding period, sir. For all the products. For perishable, it is 10 days. For this, it is 30 days. For it is 60 days. Oh, sorry. For the last one, it is 60 days. Obviously, perishable, if the goods are in the nature of the perishable, they will, they will not be in a condition to be used after 10 days, right? They have a small shelf life is less. So that is what is given, sir. The suppliers, now he is talking about the suppliers of these products provide a credit period of 30 days. 30 days is what? This is the creditors period. This is the creditors period, which is provided by whom? Provided by the suppliers, sir. Clear? Each store will employ 20 personnel of a different hierarchy, and the monthly average salary to the staff for each store is estimated at 4 lakhs per month. Right? Each store will have 20 employees and each employee will have an average salary of 4 lakh rupees, and that is per month. So multiplied by 12. So what will be the total salary cost for one store, sir? For one store, it is going to be how much, sir? 9 crore 60 lakhs. 9 crore 60 lakhs. This is for one store. One store into 20 personnel into 4 lakhs per month each. To the staff for each, no. Sorry. For each store, it is 4 lakhs per month. Sorry. It is not to be multiplied by 20, sir. It is, this 4 lakh is for the complete store. This 4 lakh per month is for the complete store. So I will multiply directly it with 1. So it will be 4 lakh multiplied by 12. That is 48 lakhs. 48 lakhs per annum. 48 lakhs per annum. Right? It is not per employee. 4 lakh is total for the store for all the 20 employees combined. The company will pay the employees dues on the 1st of next month. That is 1 month period delay in the wages. This is what? Delay. How much? 1 month. Lag period basically. Delay period, lag period, 1 month is there. Working capital, sir. We have already studied about it. Now, the Samvar Limited plans to keep the optimum cash balance in hand as suggested by the Baumol model. Excess cash balance, if any, will be invested in the marketable securities, which will generate a return of 12% per annum. The total disbursement for the year is estimated at 1.5 lakhs per month, with the transaction cost of rupees 20 per transfer to the disbursement account. The optimum capital structure with the debt equity ratio of 2:1 has been proven ideal for raising the finance, and the company wishes to follow the same pattern for the additional funds required for each store. The trade credit can also be utilized for financing the expansion needs. The cost of raising the debt and equity for each store is as per the slabs below. If you want to raise the money up to 80 lakhs, then the debt will be 10% and the equity cost will be 12.5%, right? That is KE basically. This is the KE that is given to you, 12.5%. If you want to raise more than 80 lakhs and up to 50 lakhs, the cost of debt will be 11.5 and cost of equity will increase. As you keep on increasing the debt, the cost of equity will increase, sir. Above 150 lakhs up to 250 lakhs, it will be 12% and 14%. So this is the slab rate it is given, right? So if you are raising, let's say, suppose you are raising 1 CR, 1 crore rupees. So what will happen? Up to the amount of 80 lakhs, this will happen. Then 80 to the next 20 lakhs, this will happen. So this is the slab that is given. It means that up to 80 lakhs of project, the cost of the company can raise debt 10%, equity 12.5% and so on. So this slab rate will work like this. If you want to raise 1 crore up to 80 lakh, 10% and 12.5%. For the remaining 20 lakh, it will be 11.5% and 13.5%. Tax rate is 25%. Based on the above details, calculate the following for each of the store. The optimum cash balance. Optimum cash balance is given by what? It is given by Baumol model, sir. Right? And for the Baumol model, the information is given. What do you need? You need the annual disbursement or the annual requirement. That is A. It is 1.5 lakhs per month. So A will be 1.5 lakhs into 12. Right? Because what we need is annual, sir. That will be 18 lakhs. That will be 18 lakhs. And the transaction cost is given to you. The transaction cost is rupees 20. And the carrying cost is what? The carrying cost is 12% per annum. Because he says if you do not carry the cash, you invest in the marketable securities and you earn 12%. So this is the carrying cost, now, sir. Opportunity cost. So it is 12%. So you can calculate this optimum cash balance as under root of 2 into A into T divided by C. That is under root of 2 into 18 lakhs into 20 divided by 12%. So how much it is going to be? 20 divided by 0.12 and the under root of it. So it will come to 24495. So this should be the answer, that is D part. Let's see if the answer is correct, sir. 24495, correct answer. Right? Okay, let's come to the next one. The first MCQ based on the case study is done, sir. The next he says the gross and the net working capital for the next year would be. Now, if you talk about gross working capital, what will be there in the gross working capital, sir? Gross working capital is what? The current assets only. Right? The current assets only. Now, what will be there in the current assets? Just think about the case study that you have started. What all will be there in the current assets? Sir, will there be inventory? Yes, sir. There will be inventory of finished goods because it is given. What is given, sir? This storage period is given, sir. This storage period is given, holding period. So that means at the end of the period, if you are preparing a balance sheet, at that period, you will have the perishable goods of 10 days. You will have semi-durable of 30 days and 60 days durable goods. You will be having in the stock, na, sir. Current asset is what? You take in the balance sheet. Right? And inventory represents what? The closing inventory at the end of the period. So at that particular point also, you will be holding 10 days perishable goods, 30 days semi-durable and 60 days durable goods. So it will be there, sir. Yes. Then will there be receivables? Will there be receivables? Yes, sir. Receivables will be how much, sir? That will be for, first, receivables will be for how many days? It will be for 9 days. And this receivable is only for those people who pay through debit or credit card. Do you agree with this thing? Yes, sir. Right? How many people? Out of total sale, only 15% pay through debit or credit card, and the period will be 9 days out of 360 days. Clear? Now here one more thing, sir. When we are calculating this receivables part, I'll come to the calculation. Okay, first let's discuss it. What rest will be there? Sir, will there be cash? Yes, sir, there will be a cash, and that we have just calculated as 24495. 24495. 5. This will be the cash, the difficult part, sir. Cash is the most difficult part, isn't it? Because it is given, sir. That is why it is the most difficult part, sir. Isn't it? Or sir? Anyhow, chalo. Let's see. Now, how to calculate inventory, sir? Inventory of the finished goods. Inventory of the finished goods. What is given to you? For the inventory of finished goods, perishable product comprise 20% of the sales, whereas semi-variable is 25% and the durable product is 15%. So accordingly, we will calculate what? Accordingly, we will calculate the inventory part. What is there in the inventory? Wait. Okay. Now, how do we calculate the inventory part? Just try to understand. Inventory here we are talking about what, sir? Inventory we are talking about the FG inventory. It is now divided into three parts. First of all, we will have to see what? For the working capital, what we see, what is the amount that is invested from our pocket. So I have to see what is the amount invested in the FG. What is the amount invested in FG, right? That is, I will have to take what? COGS. Now, how I can calculate COGS? How I can calculate COGS? Because for the working capital, what I need is, working capital is required to the extent the amount is actually invested from my pocket, right? In case of inventory, in the making of inventory, what is the amount that is invested from my pocket for which I require working capital? That is COGS. How I can calculate COGS? That is sales minus GP. Sales is given to you, that is 120. GP is given 18% of 120. So what will be your COGS? That will be 98.4 lakhs. Isn't it? Now, in this whole thing of inventory is divided into three parts. First is the perishable goods. First is the perishable goods. Now, perishable goods investment will be how much? On this 98.4 multiplied by 60% multiplied by what is the period? 9 by 360. So this will be the inventory that I will be holding into 9 divided by 360. That comes to 1.476. Next will be what? Next will be semi-durable goods. Next will be semi-durable goods. Right, and that will be 98.4. Total 98.4 is what? On all the goods. It is the total cost of goods sold. 25% is semi-durable into 9 by 360. So that will come to 98.4, 25% into 9 divided by 360. That comes to 0.615. And what about the durable goods then? What about the durable goods then, sir? That is 98.4 into 15% into 9 by 360, right? So 98.4, 15% into 9 divided by 360, that comes to 0.369. So what will be the total inventory here, sir? 0.615 plus 1.476, that is 2.46 lakhs. This will be the inventory of finished goods for the gross working capital under the current assets that we are going to take. Working capital is what, sir? Current asset minus current liabilities. Gross is what? Only current assets, right? So this is what the inventory of FG will be. Let's see if we are correct or not. The solution, sir, we'll see side by side only, sir. No, sir. Some mistake is there, sir. Okay, sorry. We have to take holding period, sir. 9 days is regarding the receivables. I'm taking it wrong. Sorry. Confused, sir. Okay. Here it is not 9. For in this FG, we have to take what? We have to take the holding period. Correct. 10 days, 30 days and 60 days. For inventory, we have to take holding period, na, sir. To 60% into 10 divided by 360. That comes to 1.64. Then 98.4, 25% into 30 divided by 360, that comes to 2.05, and 98.4, 15% into 60 divided by 360, that comes to 2.46. Fine, sir. Now, plus 2.05 plus 1.64, that comes to 6.15, that is 6,15,000. Now it is correct. Fine, sir. Now, receivables. What about the receivables now, sir? What about the receivables? Let's talk about the receivables now. Let's talk about the receivables now. Receivables. Okay, now what will happen in case of receivables? Again, we have to see what is the amount invested. For receivables, we can take two things. Either we take the total sales or we take what? We take cost of sales. Isn't it? For receivables also, when we are taking it for the working capital purpose, in the receivable part, what we take is either we take the total sales or we take the cost of sales. Isn't it? Either we take total sales or we take what? The cost of sale. Because the actual amount that is invested from the pocket is cost of sale. Now, cost of sale here in this particular question represents what? It is whatever the expenditure you have incurred here, COGS, we have calculated plus this expenditure that he is talking about, that for this POS system, I'll highlight what is the line here. Supplier the product, this provide this. Okay, now it will be 2% of the total sales on the POS. It will be the fee, that fee is there, 2% fee, that will be included here for the cost of sale purpose, sir, plus 2% fee of POS system. This will be your cost of sales. Right, sir? So what is the COGS in this case? The COGS here is, we have just calculated the COGS here, that is 98.4 lakhs. It is 98.4 lakhs plus 2% fee is to be charged on the total sales, right? That is on 120 lakhs I will charge. But how many customers receivables are to the extent of only 15%? The rest of the amount we are recovering in cash, sir. Receivables are to the extent of only 15%. So 122% plus 98.4 into 15%. So that comes to 15.12. This is my cost of sales. So for receivables, what will be the receivables here? That will be 15.12 for 9 days out of 360 days. That comes to 0.378. This will be my receivables. Let's see the solution now. FG inventory we have calculated 6,15,000, correct. Cash we have calculated. Trade receivables we have calculated 0.378 is what? 37,800. We will get the value of gross working capital 677. Right, so we will get the value of gross working capital, and from here what we need, we get the idea is that these two options will not be there, sir. So it will be either option A or option B. We are following the elimination method also. Now we come to the second part, that is net working capital. For net working capital, what is there? For net working capital, you need to calculate two things. One, the creditors. Right, the first thing is the creditors, the second thing is the creditors for expenses, that is the wages. Okay, now what is there for that? Come to that, sir, it will be fun. Now what is there, sir? For net working capital, what we need is, we need two things. For net working capital, okay, I'll talk about current liabilities now, sir. Current assets we have calculated. I'll talk about now the current liabilities. For net working capital, what we require is the current liabilities, sir. For current liabilities, one thing that I will require is what? The creditors for finished goods, creditors for goods, creditors for goods. Now, just listen to it very carefully. Sir, this project which this company is going to take, whether it is an old project or a new project, whether it is an old project or whether it is a new project, what it is? Sir, during this particular period, whatever will be the consumption or the sales, plus there will be a certain closing stock that you will take. Obviously, the closing stock will be there, right? Will there be any opening stock? Will there be any opening stock? Sir, this is a new project that they are taking. So this opening stock will be what? Nil. Opening stock will not be there. And what will be the closing stock that will be there, sir? What will be the closing stock that will be there, that we have already calculated for the closing stock of inventory, sir? 6.15. Because at the end of the period, right, you will have this inventory of finished good. In the current assets, what does it represent? The closing stock only, na sir. In the balance sheet, when you are taking current assets, which inventory do you take? Whether you take opening or closing? The balance sheet part, sir, accounts, simple accounts. We take the closing, right? We take what? We take the closing part, sir, right? We take the closing part. So let's see here, the trade payables. What you are going to take for the trade payables, sir? Purchases into average credit period by 360 days. Now the suppliers are providing you 30 days credit period divided by 360. What will be the purchases now? What will be your credit purchases? It will be the COGS during particular period. What will be your sales? And in the sales, what we take is the COGS, sir. Right? We are not going to incorporate the profit part. Right? Basically, how to calculate the purchases, just listen to it. All of you know trading account? All of you have understood this trading account, na sir? Trading account, we take sales here, right? And the closing stock here, opening stock here, purchases here, and the GP here. So if I take the sales and GP, what I will have is COGS. So I can say this I want to calculate. How I can calculate, sir? COGS plus closing stock minus opening stock. Clear? That will give me the value of purchases. That is what they have done. COGS we have already calculated. Closing stock we have already calculated. Opening stock will be nil. 0. This closing stock is what? The inventory of finished goods which we have shown under the current assets. So this will be the total purchases and this will give you the trade payables. Simple. Right, to be taken under the current liabilities for working capital part. The next is outstanding salaries, that is the creditors for wages, 48 lakhs for the whole year. What is the lag period? That is 1 month. 30 days is the lag period. This is what? The lag period, sir. Lag period. So 4 lakh will be the salary. So here you will get this statement. Trade payables, outstanding salaries, net working capital. From there you will get your answer. Right? From here you will get your answer that it is A part. Very important part. Very important. Good calculations. You just need to focus on the basic concepts. Then you will be able to attempt this. Okay, fine, sir. Let's come to the third part of this. The amount of total funds needed to set up a store. Amount of total funds that will be needed to set up the store. How much, sir? 200 lakhs will be required, sir. Anyhow, isn't it? Or no? Sir, the total funds that will be required is the total capital that is needed, that is 200 lakhs plus the money that is required for working capital, that is coming out to be negative. Net working capital is coming out to be negative, sir. Right? So that is why the funds required will be 194.06. This 200 is already given in the question that for fixed assets and for the procurement of the goods and all, we require this 200 lakhs plus besides this we require the money for working capital requirement for the smooth functioning of the fixed asset, isn't it? That is a working capital, and this working capital we have calculated that net working capital is negative, sir. We will be able to generate sufficient current assets. So we require less money. Important part. Coming to the next one, the fourth part, the overall cost of capital for raising the additional funds for setting up each of the stores. Now, what is the funds that you will require? The funds that you will require is 200 lakhs. And how can you acquire the funds? You can acquire the funds up to 80 lakhs. Up to 80 lakhs, the funds will be at a different rate. Then 80 to 150 lakhs, it will be at a different rate. And up to 150, then 150 to 200 lakhs, it will be at a different KD and KE. So you will have to prepare that table using the different KD, different KE, right? Oh, this is what you will have to do, sir. This is what you will have to do now, and the funds will be in the ratio of what? 2:1. So this is the table that will help you. See here, up to 80 lakhs, debt is always going to be, this debt equity ratio is going to be 2:1. That is why it is 0.67 and 0.33. What is the KD here? 10%, 1 minus tax rate, net 7.5%. KE is given as 12.5%, right? So what will be the KO? KO will be weightage into this. Weightage into this, you will calculate the KO. Right? So what will be the total cost of using this 80 lakhs? 80 lakhs into 9.167, 7.334 lakhs. What does it say? That, sir, you want to raise 200 lakhs. For that, the first slab is up to 80 lakhs. You can acquire up to 80 lakh funds at this particular rate. The cost of using that 80 lakhs is 9.167%. The total cost. How it has been calculated, sir? Debt equity ratio is given. For 80 lakhs, what will be the debt here, sir? What will be the debt and what will be the equity? Debt will be, this ratio has to be 2:1, right? So 80 divided by 3 into 2, that comes to 53 lakhs will be debt, and the remaining will be equity. Or you can simply take the weightage here. This 2:1 represents what? This represents the weightage only, na, sir. Right? For the weightage we have calculated 0.67 is to 0.33. Out of the total, what is the weightage? Clear? Calculate KD. This is weightage. This is what? Weight. And KD is calculated as what? 10%. On that, the tax impact is to be taken. And KE is how much? The KE is given as 12.5%. So this is 7.5% and this is 12.5%. So if you multiply this weightage with this and with this, what you will get is the KO. We have already studied about this KO, na, sir. KO is what? Weightage of debt into cost of debt plus weightage of equity into cost of equity. That will give me the overall cost of capital, and this overall cost of capital tells us what? That for using 80 lakh rupees, this is the cost that I have to bear. What is that? 7.334 lakhs. Similarly, for 80 to 150 lakhs, debt equity ratio is same. KD is different, KE is different. So you can calculate KO, multiply this with this, sum KO, right? Now for this 70 lakh rupees that you will use, what is the cost that you have to bear? 10.25%. That is 7.175%. Now for the next up to 200 lakhs, because our requirement is up to 200 lakhs only. So for 150 lakhs to 250 lakhs, that is for this 50 lakhs, what is the cost? Cost is 10.667%. That is 4.74 lakhs. Now, what is the interpretation? He says, if you want to use 200 lakhs, for this 200 lakhs, what is the cost that you have to bear? The cost is 7.334 lakhs plus 7.175 lakhs plus 4.7 lakhs. This will be the total cost that I will have to bear in rupee terms to utilize 200 lakhs, to raise 200 lakhs basically, right, for the store. So what is the net cost? Net cost is 19.209 divided by the funds that I will be utilizing, that is now 194.0605. Interestingly, now we are not, the funds required is not 200. This is another point that you have to be careful with, right? Total cost will be in respect to the capital that will be required. So the capital required we have just calculated as 194.0605. For this capital, what will be the overall cost? Clear? Market is a very, very important part, and this last thing you have to be very careful with. Okay, coming to the next part, the last part, this done, the amount of revenue subsidy granted by the central government. What will be the amount of subsidy, sir? What is the KO? KO is given as, KO we have just calculated as 9.90%, and it is given that if the overall cost of capital is less than 10%, subsidy will be equal to 15% of GP, right? Subsidy will be, since the overall cost of capital is below 10%, they will be eligible for the revenue subsidy, which is at the rate of 15% of the GP, sir. So GP is how much, sir? What is the GP value, sir? What is the GP value? Gross profit value 120 on that 18%. 21.6, that is 120 lakhs is the revenue. On that 18% is the GP that is given in the question. So GP is 21.6 lakh. On that 15% will be the subsidy that you will get. Clear? So this is the whole case study. Very interesting, very, very important. And I know the case studies are definitely going to consume a lot of time. Very important. So please practice all the case studies. That is a really important perspective, right? The case studies is important and how you interpret the things. And like we have seen in this particular case study that one part is related to another part. Here we calculated the cash requirement in the first part, and this cash requirement we used it while calculating this gross working capital, right? Here we calculated this overall cost, funds. The amount of funds which is required that we utilized for calculating this overall cost of capital. So one part is related to another part. This also you have to be careful with. So case study part is done. Let's come to the other MCQs which are there. Then we will wind up this particular lecture. Then we will move on. In the next part, I will be discussing about the other questions, right? Question number 2. The cost of capital of the firm is 12%, okay, and it is expected, and its expected earnings per share at the end of the year is 20 rupees. So 20 is what? E1 that is given to you. This is the cost of capital, KO is given, and the existing payout ratio is 25%. The company is planning to increase its payout ratio to 50%. What will be the effect of this change on the market price of the equity share of the company? As per the Gordon model, if the reinvestment rate of the company is 15%, R is given as 15%. Now he says, what will be, read the requirement. He says, what will be the effect of this change on the market price? So that means we will have to calculate that as per the existing criteria, what is the market price of the share? As per the revised criteria, what is the change in the criteria? That is the payout ratio, right? Under the existing scenario, what will be the payout ratio? 25%. See here, what he's saying is existing. In the existing, what is your payout ratio? 25%. That means your retention ratio will be how much? 75%. R is given as 15%. Agree. What will be the growth rate, sir? Into 15%. That will be my growth rate, sir, isn't it? Do you agree with this thing or not? 0.75 into 0.15, that is growth rate is 11.25%. This is as per the existing scenario, right? And we are required to calculate what? We are required to calculate the market price of the share according to the Gordon model. What is given to you? The KE is given to you, that is 12%. Cost of capital, it is shares only, sir, right? Then what is given? E1 is given to you. What is given to you is E1 is 20. So can you tell me what will be the D1? As per the existing scenario, dividend is 25% of this, right? Dividend is 25, that is 5 rupees. So what will be the price here, sir? We will have to calculate what? We will have to calculate price. Price will be D1 divided by KE minus G, right? So D1 is 5 divided by KE is how much, sir? 12% it is given to you, and G we have calculated as 11.25%, right? So 0.12 minus 0.1125, 0.75. So that comes to 666. According to me, this is what is the answer that we are getting, sir. Huh? Yes, sir. 666.67. This is what we are getting. Now, as per the proposed one, what will happen? What will be the changes in the proposed policy? In the proposed section, what will be your, what is your dividend payout ratio? 50%. So what will be your retention ratio? B is what? Retention ratio. R is what? 15%. So what will be the growth rate, sir? The growth rate will be 7.5%. This will be the growth rate. So what will be KE? KE is 12% only. E1 is equal to 20 itself, and D1 will be now 50%, that is 10. So what will be the price? Price will be 10 divided by 0.12 minus 0.075. So it comes to 222. So what is the change now? What is the change in the price? What is the change in the price, sir? What is the change in the price? The change in the price is reflected by here 444. So wherever you will find 44, it will increase or decrease? It will decrease. It is decreasing by 444.45. You can take it in the decimals. I have just rounded off because for the MCQ we just need an idea. Right, one thing is here, it is decreasing by around 444. So here whatever you find, decrease by 444.45. Clear? Read the requirement. Again, the requirement is what? The requirement is you have to study the effect of change in the market price of the share. Done? Okay, let's come to the question number 3, and with that the MCQs will be over, I guess. Yes sir, the MCQs will be over. Question number 3, for this RTP the MCQs will be over. Abhi Limited is an all equity financed company. What is an equity financed company known as? It is known as unlevered company. Great sir. It is considering replacing 275 lakhs of equity shares with 15% debentures of the same amount. Okay sir, got it sir. Now the current market value of the company is 1750 lakhs with the cost of capital at 20%. Current market value of the company is 1750 lakhs with the cost of capital at 20%. Okay. The future EBITs are going to be constant and the entire earnings are going to be distributed, not disturbed sir. It is going to be distributed. Right. The corporate tax rate is assumed to be 30%. What will be the new cost of equity of the firm? This is from your ICI module itself. This is from your ICI module itself. Now, what is there, sir? There is an unlevered company. There is a tax rate also. There is a tax rate also. Whenever there is a tax rate, what is given? The value of the firm is given to you. Value of the firm, current value of the firm is given as 1750 lakhs. 1750 lakhs, and the cost of capital, now it is an unlevered firm. In that case, the KE will be equal to KO will be equal to 20%. Right? Now, if I want to calculate EBIT here, how I can calculate? It is now that it is with the tax. It is a MM theory. This question is on MM theory with taxation 1963. How I can calculate, sir? It is given that KE or value of firm, the KE is equal to EBIT into 1 minus tax rate divided by the value of firm. So KE is given 20% is equal to EBIT into 1 minus tax rate divided by the value of firm is given as 1750. See here, what is the requirement? The requirement is to calculate the cost of equity. For cost of equity, I need two things. One is the residual earnings. Another thing that I require is what? The value of equity. For that, I require EBIT. Without EBIT, I will not be able to calculate what? I will not be able to calculate the residual earnings, sir. So from here, that is the first step I am following, calculation of EBIT. I'll take this here and take 1 minus x in the denominator. So my EBIT will be what? EBIT will be 20% of 1750 divided by 1 minus 0.30. So what is the EBIT here, sir? 1750, 20%, that comes to 500. Now he says the EBIT will remain constant, sir. Even if you are going from unlevered to levered company, EBIT will remain constant. Fine, sir. Now what I can do, if I prepare the statement now, the statement will look like the EBIT is how much? 500. On that EBIT, I will pay interest on debt. What will be the debt? Debt will be this 275 lakhs will be my debt because they are converting this equity into debt at the rate of 15%. Right? So 15% of 275 will be my debt, sir. 275 15%, that is 41.25 is my debt. So this will be what? The earnings before taxes, 500 minus 41.25, that is 458.75. On this I will pay a tax at the rate of 30%, right? That will be 137.63, right? So 458.75 minus 137.63, that will give me 321.12. This will be what? This will be my residual earnings, or what we call it as earnings available for equity shareholders. This will be my residual earnings, or the earnings that is available for equity shareholders. This is first part that I need for KE. For KE I require what? I require residual earnings. I require what? The residual earnings divided by the value of equity. Residual earnings I have calculated 321.12. Now how I can calculate the value of equity after the repurchase? This value of equity is what? In the levered company. Now we have learned one more thing, sir. Value of levered company is what? Value of levered company is value of unlevered company plus debt into tax rate. This is what I have told you, right? What is the value of unlevered company? That is 1750 given, plus debt is how much? 275 lakhs. Tax rate is how much? 30%, right? So this will be 183.2.5. Now this is what? This is the value of firm. Which firm? Levered company. This is the value of levered company, sir. This 1750 is what? This 1750 is the value of unlevered company. Now after you introduce the debt, this value has changed to 1832.5. This is how we calculate the value in the levered company. Value of firm, unlevered firm plus debt into tax benefit on the debt, minus value of debt, that is 275, which is given. So I will get what? The value of equity, 1557.5. So divided by 1557.5 into 100. So 321.12 divided by 1557.5 into 100, that will give me 20.62%. What is the answer here, sir? 20.62%. Sorry, this is not C, this is D. Wrong. Printed wrong, sir. This is D. 20.62%. Clear? So we are done with the MCQ part of this RTP. Very, very important. Please, after this lecture, go through with this complete MCQ part once. In the next part, I am dividing this RTP into two segments so that you can first absorb the MCQ part, and then I will move on to the other part of the discussion in the next part of this series, right, where I'll take up question number 4, which is quite easy. Question number 4 is not that difficult. Question number 5 is also very, very easy, straightforward question. It is also not difficult, but I will discuss all the questions with you guys, right? Question number 6 is also very easy. I'll discuss all the questions, don't worry, right? Question number 7 is on the leverages, which you already have in the module also, right? And question number 8 is also a good one, right? But we will discuss, don't worry. I'm just going through with the question. Question number 9 is on capital budgeting, which is again a very good one. Then question number 9 is on what? Question number? After 8 it is directly 10. Some mistake seems like some. No, 9th is okay. 9th is on capital budgeting, then 10 on working capital. Right. Rest of the part we will take up in the next video. Please go through with all these questions, all these MCQ and case study part, whatever we have discussed, which is very, very extremely important from the examination point of view. And this will give you a good practice of how to tackle the MCQs and the case study part, right? So see you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.